Right now, as you watch this, something unprecedented is unfolding in the shadows of global finance. On February 4th, 2026, the Financial Stability Board issued an urgent warning. They identified a $16 trillion vulnerability. Most people scrolling past headlines have no idea what this actually means. But if you have a retirement account, a mortgage, or any wealth tied to the Canadian banking system, this affects you directly. This is not a drill. This is the mechanism hiding in plain sight. The plumbing is breaking. And once you understand this mechanism, everything else makes sense. Here's what the FSB revealed. Government bond-backed repo markets, the invisible machinery that keeps banks liquid every single day, are experiencing what they call extreme leverage and supply imbalances. $16 trillion. That number should not exist in a functioning system, but it does. And this part has already begun. Let me be precise about what a repo market actually is, because this is the part nobody is supposed to see. A repurchase agreement is a short-term collateralized loan. Think of it as overnight borrowing. A bank or hedge fund sells government bonds, usually U.S. Treasuries, and promises to buy them back the next morning at a slightly higher price. The difference is the interest rate. Simple enough? Except it's not simple at all when you scale this to $4 to $5 trillion per day in the US market alone. Globally, we're talking tens of trillions. This is where the countdown actually begins. Repo markets are called the plumbing of the financial system for a reason. They provide daily liquidity. Every morning, banks wake up needing cash. They use repos to fund their bond inventories, their trading desks, their lending operations. Without repo markets, the entire system seizes. No liquidity means no loans. No loans means no credit for businesses, no mortgages for families, no functioning economy. This isn't happening to the market, it's happening to you. Here's the mechanism no analyst is willing to explain. The repo market doesn't just facilitate borrowing, it amplifies leverage. Hedge funds, those shadow players managing trillions outside traditional banking, use repo financing to juice returns. One popular strategy is called the basis trade. They exploit tiny price differences between cash treasuries and treasury futures. Sounds technical, it is, but here's what matters. These trades are leveraged 20 times or more. $20 of exposure for every dollar of capital. And it all runs on repo financing. This is not theoretical, it's observable. When volatility rises, repo lenders get nervous. They increase what's called the haircut, the amount of collateral required for each loan. Higher haircuts mean hedge funds must deleverage, sell assets fast. And here's where everything changes. Because when everyone tries to sell at once, prices collapse. Government bond prices fall, yields spike, borrowing costs across the entire economy explode. This part isn't a prediction, it's math. Let me show you what actually happened. September 2019, U.S. repo rates, normally stable around 2%, spiked to nearly 10% intraday, 10% for overnight borrowing. The Federal Reserve had to intervene with emergency liquidity operations. It wasn't a banking crisis in the traditional sense, it was a plumbing failure. The pipes froze, and the Fed had to pump liquidity manually to keep the system alive. Then came March 2020. The COVID liquidity shock hit repo markets like a freight train. Volatility surged, lenders panicked, haircuts rose, hedge funds scrambled to deleverage. The Fed expanded repo facilities and launched massive asset purchases, trillions of dollars, to stabilize the system. This wasn't a conspiracy, it was stated emergency policy, but that's not the real problem. The real problem is what happened next. After 2020, leverage didn't decrease, it increased. Non-bank financial intermediaries, hedge funds, private credit funds, shadow banking entities now control over $200 trillion in assets globally. 200 trillion. The Financial Stability Board has been warning about this for years, and on February 4th, 2026, they issued their most urgent alert yet: $16 trillion of vulnerability concentrated in repo markets, extreme leverage, supply imbalances. The language is diplomatic, the reality is catastrophic, and this is where the first domino falls, because Canada is not insulated. The big six banks, RBC, TD, BMO, Scotiabank, CIBC, National Bank, are deeply interconnected with global repo markets. They operate in New York, they operate in London. They hold massive government bond inventories. They rely on wholesale funding, borrowing from other institutions, not just customer deposits. If US or UK repo markets freeze, Canadian banks lose access to dollar liquidity instantly. This is where the cascade becomes unstoppable. Here's what that looks like on the ground. Imagine a repo freeze in New York. A major hedge fund can't roll over its overnight borrowing. It's forced to sell treasuries. Prices drop, yields rise, other hedge funds hit margin calls. They sell too. The selling accelerates, fire sales. Within hours, the repo market seizes. Lenders stop lending, even to banks, even to Canadian banks trying to fund their US operations. The Canadian banks suddenly face a liquidity crisis. They can't access short-term dollar funding. They're forced to pull back lending in Canada. Mortgage rates spike. Credit tightens. Businesses can't roll over loans. The Canadian dollar weakens as confidence erodes. For the average household, this means higher borrowing costs, tighter credit, and collapsing home equity. For pensions relying on stable returns, this is catastrophic. But we haven't even reached the breaking point yet. Let me cut through the noise. The repo market is built on a foundation of trust and liquidity. When trust evaporates, liquidity vanishes. And when liquidity vanishes, the system doesn't slow down, it stops. This is not cyclical, it is structural. The deficit in liquidity is not shrinking, it is accelerating. And the Financial Stability Board just confirmed what some of us have been saying for years. The system is already under stress. Here's the detail even analysts tend to miss. U.S. Treasury securities are the dominant collateral in global repo markets. They're considered the safest asset. But safe doesn't mean infinite. Treasury issuance has exploded. The U.S. government is borrowing trillions annually. More treasuries means more collateral, but it also means more bonds that need to be financed. And here's the paradox. The more treasuries flood the market, the more repo financing is required. The system becomes more dependent on the very mechanism that's breaking. This is where common sense actually becomes your enemy. You'd think more treasuries would make the system more stable, more collateral, more liquidity. But that's not how leverage works. More collateral enables more borrowing. More borrowing creates more fragility. And when the music stops, everyone realizes they're holding the same crowded trade, a default in all but name. Let's be precise about timing. September 2019 was a warning shot. March 2020 was a near miss. The UK gilt crisis in 2022, tied to leveraged liability-driven investment strategies, was another fracture. The Bank of England had to intervene to prevent disorderly collapse. Each event required central bank intervention. Each event was larger than the last, and each event left the system more leveraged than before. This is vanishing in real time. Here's what I call the big secret of the entire system. The repo market doesn't exist to facilitate prudent borrowing. It exists to enable maximum leverage. Hedge funds aren't borrowing to invest long term. They're borrowing to amplify short-term bets. 20-to-1 leverage isn't risk management, it's speculation. And when speculation dominates the core funding mechanism of the global financial system, you don't have a market, you have a time bomb. The window is not closing, it is slamming shut. Because once repo markets seize, once lenders refuse to lend overnight, there is no gradual adjustment, there is no smooth deleveraging, there is panic, fire sales, cascading margin calls, and institutions that looked solvent yesterday become insolvent today, not because their assets are worthless, but because they can't fund them. For your 401k, this means forced selling by hedge funds holding treasury positions unravels bond market stability. For your IRA, this means equity markets experience contagion as liquidity dries up. For your portfolio, this means correlations break down. Everything falls together. Safe assets stop being safe, and the diversification you thought protected you evaporates. But this isn't even the part that scares me. The part that scares me is the interconnection, because the repo market isn't isolated. It's the beating heart of a much larger organism. When repo markets seize, the contagion spreads instantly. Corporate bonds, municipal bonds, mortgage-backed securities, commercial real estate debt, everything that depends on liquid funding markets gets hit simultaneously. And here's the kicker: your retirement portfolio is exposed to all of it. Let me walk you through the domino sequence. This is not speculation. This is the observable chain of causation that begins the moment repo markets freeze. Step 1, the haircut shock. Repo lenders demand higher collateral. A hedge fund that could borrow 98 cents for every dollar of treasuries suddenly can only borrow 95 cents. Doesn't sound like much, but when you're leveraged 20-to-1, that 3% haircut increase forces you to liquidate 15% of your positions immediately. Multiply that across hundreds of hedge funds managing trillions. The selling begins. Step 2, the treasury dump. Treasuries hit the market in waves. Prices fall. Yields spike. The 10-year treasury yield, the benchmark for all borrowing costs, jumps 50 basis points in a day. Then another 50. Mortgage rates, which track treasury yields, explode higher. The 30-year fixed mortgage rate that was 6% yesterday is suddenly 7%. Then 8. Home buyers vanish. Refinancing stops. Real estate markets freeze. Step 3, the credit crunch. Banks watch treasury yields surge and immediately tighten lending standards. Why lend to businesses or consumers when risk-free government bonds suddenly offer much higher returns? Credit dries up. Small businesses can't roll over lines of credit. Corporations postpone expansion. Layoffs begin. The economy contracts. Step 4, the pension panic. Pension funds and insurance companies hold massive treasury positions. They're marked to market daily. When treasury prices collapse, their balance sheets show instant losses. Underfunded pensions become critically underfunded. Insurance companies face capital adequacy violations. Regulators demand they raise cash. They sell more bonds. The selling accelerates. Step 5, the equity cascade. Stock markets don't exist in a vacuum. When credit markets seize and treasury yields spike, equity valuations collapse. The earnings multiple the market will pay shrinks instantly. The S&P 500 doesn't decline gradually. It gaps down 5% in a morning, then another 5% the next day. Your 401k balance doesn't trend lower, it plunges. And once panic takes hold, rational pricing breaks down entirely. Step 6, the currency crisis. Foreign holders of U.S. treasuries, China, Japan, Europe, watch American repo markets seize and make a calculation. If the U.S. can't even fund its own government bonds smoothly, what does that say about dollar stability? They begin reducing exposure, selling treasuries, diversifying into other currencies. The dollar weakens. For Canada, This is existential. The Canadian dollar is deeply correlated with US dollar strength. When the greenback falls, the loonie collapses. Imported goods become instantly more expensive. Inflation surges. Your purchasing power erodes overnight. And here is where the mechanism quietly began. Because this isn't a future scenario, the stress is already present. Repo rates have been volatile for months. The Financial Stability Board didn't issue that February 4th warning randomly. They issued it because they're seeing the same data we're seeing: leverage at record highs, liquidity at critical lows, and a system so tightly wound that a single shock, a geopolitical event, a policy mistake, a hedge fund blow-up could trigger the cascade. This is not a market event. This is a monetary event. Let me be precise about what a monetary event means for your wealth. In a market event, prices adjust. Some assets fall, others rise. Diversification helps. Risk management works. But in a monetary event, the infrastructure itself breaks. The mechanism for pricing assets fails. The system for clearing transactions seizes. It's not that your stocks are worth less, it's that you can't trade them. It's not that your bonds have declining value, it's that there's no functioning market to sell them in. Here's the part they're not telling you in the official reports. The repo market processes $4 to $5 trillion daily in the US alone, every single day. That's larger than the entire Canadian economy. Every week, when that market freezes, even briefly, the ripple effects are catastrophic. And the Financial Stability Board just confirmed that $16 trillion of exposure is sitting on a foundation of extreme leverage and supply imbalances. The data forces one conclusion: we are not in a stable equilibrium. We are in the eye of a storm. Now let's talk about Canada specifically, because this is where portfolio risk becomes personal risk. The big six banks aren't just exposed to repo markets, they're active participants. They use repo financing to fund their bond trading operations. They lend to hedge funds using repo agreements. They hold Canadian government bonds that they finance in repo markets. And crucially, they rely on access to US dollar repo markets to fund their American operations. Here's what nobody expects: if US repo markets seize, Canadian banks don't just lose a funding source, they lose the funding source, because the alternative, raising deposits from Canadian savers, can't scale fast enough to replace wholesale funding. The banks would be forced into emergency deleveraging, selling assets, cutting lending, raising capital. And all of this happens while markets are already in panic mode. For the average household, this translates directly into mortgage stress. Canadian variable rate mortgages are tied to the Bank of Canada's policy rate. But when credit markets seize globally, the Bank of Canada faces an impossible choice. Do they raise rates to defend the currency, or do they cut rates to support the economy? Either choice creates losers. Rate hikes devastate borrowers. Rate cuts destroy savers. And the Canadian dollar weakens regardless, because global confidence in Canadian banks evaporates. This was inevitable the moment leverage exceeded prudent limits, and that moment was years ago. Let's zoom in on the insurance sector for a moment, because this affects retirement security directly. Insurance companies and pension funds are the largest institutional holders of government bonds. They need safe, liquid, long-duration assets to match their liabilities. Treasuries fit perfectly. But safety is an illusion when the repo market that finances those treasuries is unstable. When treasury prices collapse due to forced hedge fund selling, insurance companies and pensions show instant mark-to-market losses, billions, tens of billions. And once those losses appear on balance sheets, regulators step in. Capital requirements must be met. Cash must be raised. More bonds must be sold. This is the doom loop. Forced selling begets more forced selling. Prices fall further, losses mount, and the spiral accelerates until central banks intervene with overwhelming force. But by then, the damage is done. Pension funds are underfunded, insurance companies are weakened, and retirees discover their promised payouts are no longer guaranteed. Here's what I call the silent run. It's not depositors lining up outside banks. That's the 1930s. The modern bank run happens in repo markets. It's institutional lenders refusing to roll over overnight loans. It's money market funds withdrawing from commercial paper. It's hedge fund prime brokers raising margin requirements. The public never sees it. The news doesn't report it, but the effect is the same. Liquidity vanishes, credit freezes, the system stops. And this part has already begun. September 2019 wasn't a random event. It was a preview. March 2020 wasn't a COVID anomaly. It was a stress test that the system barely passed. The UK gilt crisis in 2022 wasn't a British problem. It was a global warning. Each event revealed the same underlying vulnerability. The repo market is the single point of failure for the entire global financial system. This is where the crack becomes an earthquake. Because the system isn't just vulnerable to repo market stress, it's designed to amplify it. Leverage amplifies returns in good times, but it amplifies losses in bad times. And when the entire system is leveraged, banks, hedge funds, pensions, insurance companies, the losses cascade through every connected node. Your portfolio doesn't decline in isolation. It declines because everything declines. Asset allocation becomes irrelevant. Diversification fails. And the only assets that hold value are the ones that don't depend on the system functioning. Let's be precise about timing again. We don't have months. The Financial Stability Board issued that warning on February 4th because they're seeing stress indicators flash red. Repo rate volatility, collateral scarcity, leverage at extremes. They're not issuing warnings for fun. They're issuing warnings because the system is approaching critical thresholds. And once those thresholds are breached, there is no gentle correction. There is only collapse or intervention. For high net worth investors, this means understanding that wealth preservation requires more than traditional diversification. It requires assets that function outside the banking system, physical assets, commodities, hard assets that don't require overnight repo financing to maintain their value. Because when the plumbing breaks, paper assets become exactly that, paper. But once this shifts, everything above it starts to shake. The repo market is the foundation. Corporate debt markets sit on top of it. Equity markets sit on top of that. Real estate markets depend on credit markets. Pension systems depend on stable returns. Insurance systems depend on actuarial assumptions that assume functioning markets. And all of it rests on the assumption that repo markets will continue providing $4 to $5 trillion of daily liquidity without interruption. That assumption is now in question. Here's the moment the clock actually starts. Because once you understand that the entire financial system rests on a repo market processing trillions daily, and that same repo market is experiencing what the Financial Stability Board calls extreme leverage and supply imbalances, you realize we're not discussing theoretical risk. We're discussing present danger. And the institutions responsible for managing that danger just issued their most urgent warning yet. Let me show you the mechanism they don't want explained publicly. When repo markets function smoothly, they're invisible. Banks borrow overnight. Hedge funds leverage their positions. Money market funds earn a return. Everyone pretends the system is stable. But repo markets only function smoothly when everyone believes they'll function smoothly. It's a confidence game, and confidence, once lost, doesn't return gradually. It disappears instantly. Here's the historical pattern. Every major financial crisis begins in the shadows. The subprime mortgage crisis didn't start on front pages. It started in obscure corners of structured finance markets. The 2008 collapse didn't begin with Lehman Brothers failing. It began months earlier when repo lenders started refusing to accept certain collateral. The European sovereign debt crisis didn't start with Greece defaulting. It started when repo markets began pricing Greek bonds as risky collateral. Notice the pattern. Repo markets are always the early warning system, and they're flashing red right now. Let's talk about what this means for your credit access, because this isn't abstract. When repo market seize, banks immediately tighten lending standards across the board. The credit card you've had for years suddenly has its limit reduced. The line of credit you rely on for emergencies gets frozen. The business loan you were planning to apply for becomes unavailable at any price. Banks aren't being malicious. They're protecting themselves because when wholesale funding markets freeze, banks hoard liquidity like survivors hoard food after a disaster. And here's where everything changes for small businesses. The backbone of the Canadian economy, small and medium enterprises, relies on rolling credit facilities. They borrow to manage cash flow, pay suppliers, make payroll. When banks pull those credit lines, businesses don't gradually adjust. They fail. Layoffs happen fast. Supply chains break. And the economic contraction accelerates beyond what any policy response can counter. For your mortgage, the math becomes brutal. Canadian households are among the most indebted in the developed world. Mortgage debt alone exceeds 1.8 trillion Canadian dollars. Much of that is variable rate. When repo stress forces the Bank of Canada to respond, whether by raising rates to defend the currency or cutting rates to stimulate the economy, mortgage holders get squeezed either way. Rate hikes mean payment shock. Rate cuts mean currency collapse and imported inflation. There is no escape route. This is the moment small businesses get crushed because they're the most vulnerable node in the system. They don't have the balance sheet strength of large corporations. They can't access capital markets directly. They depend entirely on bank credit. And when banks are facing their own liquidity crisis due to frozen repo markets, small business lending is the first thing cut, not reduced. Cut completely. Let me walk you through what a repo freeze does to real estate markets specifically. Real estate depends on credit. Buyers need mortgages. Developers need construction loans. Investors need leverage to make returns work. When credit markets freeze, real estate doesn't correct gradually. It gaps down. Transactions halt. Sellers can't find buyers at any price, and the collateral value supporting trillions in existing mortgages evaporates. Canadian real estate is particularly vulnerable because prices are so elevated relative to incomes. The only reason current prices are sustainable is because credit is available and rates are manageable. Remove either variable, credit availability or rate stability, and the entire market reprices violently. We're not talking about a 10% correction. We're talking about a repricing event where certain properties lose 30 to 40% of value because there are no buyers with access to financing. And here's the cruel irony for homeowners. Your home equity, the wealth you've built over years, isn't actually wealth until you can access it. If repo markets seize, banks stop offering home equity lines of credit. They stop approving refinancing applications. The equity trapped in your home becomes theoretical. You can't borrow against it. You can't sell into a frozen market. It exists on paper, but not in reality. Let's be precise about the insurance sector's exposure one more time, because this affects retirement security in ways most people don't understand. Your pension, whether defined benefit or defined contribution, holds government bonds. Those bonds are valued at market prices. When repo stress forces mass selling of treasuries and yields spike, bond prices collapse. The pension fund's assets drop instantly. If the pension was 90% funded before the crisis, it might be 70% funded after. That shortfall doesn't get made up by markets recovering. It gets made up by reducing benefits or requiring higher contributions. Either way, you pay. Insurance companies face identical math. They hold treasuries to back policy obligations. When treasury prices fall, they face capital shortfalls. Regulators demand they restore capital ratios. The only way to do that quickly is sell more assets, which drives prices lower or reduce policy payouts. Life insurance policies get restructured. Annuity payments get delayed. And the financial security you thought you'd purchased disappears when you need it most. Here's what they're not telling you about systemic risk. Systemic risk doesn't mean everything fails. It means everything fails simultaneously because everything is connected through the same mechanism. That mechanism is the repo market. Banks need repo to fund bonds. Hedge funds need repo to leverage trades. Money market funds need repo to earn returns. Insurance companies and pensions need liquid treasury markets that depend on repo functioning. When the mechanism breaks, every institution that depends on it experiences stress at exactly the same moment. And here is where the cascade becomes unstoppable. Because stressed institutions make defensive decisions that stress other institutions. A bank pulls credit lines to conserve capital. The businesses affected fail to pay suppliers. The suppliers default on their own obligations. The bank that pulled the original credit line now faces a wave of defaults from the supplier network. The losses mount. The bank pulls more credit. The spiral accelerates. This part is non-negotiable. Once the cascade starts, it doesn't stop until either the system collapses entirely or central banks flood the system with liquidity on a scale that makes 2008 and 2020 look small. And here's the challenge. Each intervention creates more leverage. Each rescue increases moral hazard. Each bailout makes the next crisis larger. We're not solving the problem. We're postponing it and making it worse. By the time this hits headlines, the exit doors will already be locked. That's how repo crises work. They're invisible until they're catastrophic. September 2019 became visible for one day when rates spiked to 10%. Then the Fed intervened and everyone forgot. March 2020 became visible for 2 weeks during peak COVID panic. Then central banks deployed trillions and everyone moved on. But the stress never disappeared. It just moved deeper into the system. The Financial Stability Board sees this. That's why they issued the February 4th warning. $16 trillion of exposure, extreme leverage, supply imbalances. They're telling you, in diplomatic language, that the system is vulnerable to a shock it cannot absorb. They're not predicting when that shock arrives. They're confirming that when it does arrive, the consequences will be severe. For your portfolio, the question becomes stark. Do you hold assets that depend on the system functioning, or do you hold assets that function regardless of system stability? Stocks require functioning exchanges and clearing systems. Bonds require functioning repo and credit markets. Even cash in a bank account requires the bank remaining solvent and able to access liquidity. The only assets immune to systemic breakdown are physical assets that don't require institutional intermediation. This is not investment advice, this is risk assessment. Understanding that your wealth is currently stored in a system the Financial Stability Board just confirmed is vulnerable to catastrophic failure is not alarmism, it's arithmetic. And refusing to acknowledge that arithmetic because it's uncomfortable doesn't make you prudent, it makes you unprepared. Here's the truth no financial advisor wants to say out loud. Asset allocation strategies assume the system functions. Diversification strategies assume markets remain liquid. Risk management strategies assume correlations stay within historical ranges. But in a repo crisis, a true systemic seizure, none of those assumptions hold. Everything becomes correlated to one. Liquidity disappears everywhere simultaneously. and the optimal portfolio allocation becomes irrelevant because you can't rebalance when markets are frozen. Certainty always arrives too late to act on. That's the curse of systemic crises. By the time everyone agrees the crisis is real, the mechanisms for responding to it have already failed. By the time repo market dysfunction makes front page news, repo markets have already seized. By the time your financial advisor calls to discuss portfolio adjustments, the portfolio adjustment window has already closed. Right now, you can still understand the risk. You can still assess your exposure. You can still make decisions based on information rather than panic. But that window is shrinking, not because collapse is imminent, no one can predict exact timing, but because the stress indicators are multiplying. Repo rate volatility, leverage at extremes, central bank warnings becoming more urgent. The pattern is clear to anyone willing to look. When the music stops, the only question that matters is simple. Do you hold an asset or do you hold a promise? Because in a systemic crisis, promises break, counterparties fail, institutions default, and the only things that retain value are the things that exist independently of institutional guarantees, not because institutional systems are inherently fraudulent, but because institutional systems require daily liquidity to function, and daily liquidity requires functioning repo markets, and functioning repo markets require confidence, and confidence once shattered takes years to rebuild. The Financial Stability Board just told you the foundation is cracked. $16 trillion of exposure resting on extreme leverage and supply imbalances. That's not hidden information. That's an official warning from the institution responsible for monitoring global financial stability. They don't issue warnings like this casually. They issue them when the risk is material, present, and potentially catastrophic. Your retirement, your wealth, your portfolio, your mortgage, your credit access, your economic security, all of it depends on systems that depend on repo markets continuing to function smoothly under stress. And the institution monitoring those systems just confirmed they are not confident those systems can handle the stress levels they're currently observing. This is not a conspiracy. This is not a theory. This is the stated position of the Financial Stability Board based on observable data about leverage, collateral imbalances, and systemic vulnerability in a $16 trillion market that processes the daily liquidity requirements of the global financial system. The plumbing is breaking, and once it breaks, everything that depends on that plumbing stops working. Not gradually, instantly. That's the nature of liquidity crises. And that's why this matters to you right now, today, regardless of when or if the actual crisis materializes. Because by the time you're certain it's happening, it's already too late to respond.